Greetings, market rebels and market watchers. Welcome to this week's macro measure video combined with the sector situation video. It is Friday, March 20th, 2026. I am Wayne, and let's see here. Here's the Trusted Market Rebellion disclaimer. Here is the Trusted Market Rebellion intellectual property rights notice. And here is last week's slide. It's probably I think it's just about 3:30 here on the East Coast, so there's a little bit of time left in this market. I'm sure a lot of folks would rather just see this thing close. I'm just going to bring this up very briefly. This is probably going to be one of our messier, messier videos. I'll do the best I can as always, but best I can just kind of feels like a sloppy mess these days compared to way back when. But it is what it is. We just are doing the best we can here. Um, yeah, so last week we went with down 5%, never felt so bad. And just some of the hot pink highlights we had mentioned a few weeks back, which we'll mention again, right? That the weeklies were starting not to look good, and we were wondering, right, is this going to be real or false, right? Didn't know if it was going to be a real rollover. It sure seems like one now. And we also said that the March candle got off to a rough start as well. So probably looking at those bigger picture time frames coming under pressure, not looking as stellar and sparkly was probably a good thing to note again, anyway. Still felt that these risks were underappreciated. Remember, I haven't mentioned again this week, but we were talking about essentially, right, the second, third order effects of what happens when something like this Iran conflict situation, whatever you care to refer to it as, starts to happen. You know, what else becomes problematic, right? Or could become problematic. And it seemed like the market just, I don't know. I felt like to me it was like, well, wait a minute, like what's happening here? But maybe they're finally starting to get that priced in a little bit more. Um, the CTAs are set to be heavy sellers. After a rally attempt, which we'll talk about early in the week, that was it. Once you got to resistance, CTAs and others just have been leaning right heavily on stock prices. We talked about something else that was key, which was that Mag 7 was staring into the abyss. We said it needed the bottom and bounce there. Didn't happen. Only got worse, which we'll see, I believe, unless something crazy happened in the last few minutes that I haven't seen. Anyway, these are some of our repeated points, right? If we're to believe that the bull market has many years to run, should we be all in at all times, or should we wait until the clouds pass to really maybe get bigger, more aggressive? Do we have to place our full bet effectively, right, on every hand they deal us? Something that's just worth thinking about because I don't see it that way. I don't see that you should. I like the idea that when it looks a little concerning, you can do certain things. One thing I'll try to remember to show is something I've actually implored people to do probably at least half a dozen to a dozen times over the last several years, at least that many times over the last, say, 7 years, because you have your ups and downs in the market. And that is that Ryan has been putting on some of these types of trades, which we're referring to in this final line here in the Phoenix portfolio. And I mentioned the portfolio protection course that Rebels, I think, have access to, I think. And I wanted to show some of the results, not back padding stuff. You know, Ryan's the one that put the trades on, but these are the things that we always encourage people to consider and have ready to go if they're worried. They want to try to hedge a little bit, right? Or even just get very aggressive and make some money on it. So anyway, that's some from last week. This week we had to drop down to an even smaller font. I don't even know what I'm going to do about this. I mean, I just feel like it's time to just kind of come back to this. I'll try to go along with it as on the side, but there's so much stuff here that this doesn't even do it justice, frankly. But I'll leave it up there for a little bit longer. I don't know what else to say. I just if you want to try to keep things simple with one or two indicators and act as if that's all you need, you know, that's not my style. And I think there's a lot of, I think one reason why the market is hard is that, and always challenging, is that, right, there's a lot of different things that can impact the market, and a lot of factors and things worth mentioning, so that, right, you're prepared in case there is a shift in the dynamic. Not by a dynamic, I mean momentum, right? If things start shifting, maybe there's a reason that you'll see why, or you can understand why things start shifting at a certain point for certain reasons. Anyway, that's pretty much it. Might come back to this later. Let me just stop the share. We're going to get right into other things because I don't even want to go through this. It'll just, I think if I go through this point by point right now, it's going to take too long. And maybe some of this will come up in our discussion. So let's just see if we can do that. And I think what I'm going to do first of all, get the right screen shared. In this case, screen 5 is the one. And this is part of those points that we are going to cover. So I mentioned this last week. It was sort of off camera, if you will. And last week, I believe this is sharing properly. Yeah, last week I talked about AAII, and I talked about um, CNN, and the imperfect nature of the CNN indicator, but it's something we can at least reference, and that tends to be more short term, and then Bank of America's was more long term, and I didn't show any of those. So I'm just going to show a few factors here that, just so everyone understands, where we're coming from right now and what I was referring to. It just, this is the trade-off of trying to cut the time down. You end up just skipping through and mentioning things, and probably regular viewers understand that, but if you're relatively new, you might say, what's this guy talking about? Anyway, here's the AAII sentiment survey. And we talked about how last week was a very high bear reading, and that these levels, right, where there's few bulls, many bears, that's often the conditions that precede um, relief rallies, right, or squeezes back up. Not to the day or the week, but often you get there, and then shortly thereafter, right, you do finally see something. So we had to note that, because that was the case, because 46 is pretty steep. But this week you could see it's 52, and that really surpasses anything else on this 6 month look back effectively, right? I think the only other one that was even close is that November 12 reading of 49.1% bears. And so if we go back, this is a little bit better of a look that I was able to find from macro micro, and you can see, excuse me, the red line is the one we're looking at. So I'm just going to mouse over that and put that in perspective. And you can see that there have been a few occasions, right, where, well, it won't let me do it the way I prefer to, but there have been a few occasions where they have had, boy, just the line just won't sit there for some reason. I don't know why exactly, unless I'm over the one that's covering up a lot of the recent data. But you can see the red line does at times get a little bit higher than this, where the percentage of bearish responses is a little bit higher. So you're not at extreme, but you're getting to extreme levels. And as I note, right, this is contrarian. So often you'll see where this will precede, excuse me, this will precede the a bounce of some kind. Okay. Um, Fear, greed, if I update this, it might even be worse, because probably when we had it at 14, it's still at 14. Okay, so rough stuff, right? You know that we're in extreme fear at this point. I'm not even going to go through this. The timeline, I wish there was a little bit more time. It only gives us, really looking back a year that I know of. I don't think there's any way for me to modify that. Anyway, it's imperfect anyway. Bottom line is, at least it gives us something. You can see that you're getting down towards levels, right, from which we have bounced before. Not quite there yet. So that gives you an idea of what we were talking about, I hope. The other thing that I would mention is right here. This is where when I talked about, this is another point on our slide. This is from a while back, but this is the 2-decade high for Bank of America's bull bear indicator, points to stock market peak strategist, says, notice that the date is February 6th here, right? So that's the thing, right? February 6th. And that's probably not too long thereafter from when the market actually had topped, maybe just prior to that. At least the spiders, I believe, did. So bottom line is that, as we said, right, when you're in the consensus and everyone's convinced, right, that we're just about to keep going higher, you really have got to be careful. I think I tried to make this point a few times and even said I felt uncomfortable myself when things look really great to finish the year and start the year. I think I can't remember, if I say this in a video or in a webinar, so please forgive me if you watch every video and you didn't hear it. If that's the case, it's probably because I said it in a webinar. But anyway, the point is, right, that when you're there, you've got to be careful. When we're getting there, where there's so many, if you look at the numbers, right, you're getting to where you're near extreme sort of peak bearishness too. You're not there, but you've got to be cognizant of that, even if you are a bear, because that's where these very sharp relief rallies come from at times. And that's why you've got to be ready, because more than likely, unless right news develops in such a way, more than likely you just don't go down in a straight line. That's what history's shown us. So because of that, right, we don't really want to just assume we're just going to keep going down day after day after day after day without any real relief rally. At some point, which could just be something that you should fade. Anyway, getting to the guts of the whole thing, right? Getting to the point. This is from, I believe, this is from B of A as well, and this is from really right yesterday. And so this is showing that this is what I was referring to with respect to sort of like the capitulation, final sell-off, etc. type stuff. That's the problem. I could literally do like an hour of this of stuff that we come across every week, doing the best we can to keep up on things, and we just don't have time for it in a video. Everybody seems to want super short, super sweet, but it doesn't really paint the full picture. It leaves a lot of details out, unfortunately. Anyway. You still have 37% of recent survey participants that are still overweight equities, right? So that's sort of telling you something, right? That belief is still there, and that might argue that you need to see more before so many people become despondent that are really still overly bullish. Cash levels are still neutral, right? So they're below the 5% threshold that B of A uses as a buy signal. In other words, when more people go to cash, and then the bank still sees, right? This is the bank that told you, well, this is the indicator that told you about 6 weeks ago that it was rarely gets better. Something I think we were also mentioning somewhere near there. We have to be careful when it rarely gets better and everybody thinks the same thing practically. And then the bank still sees positive breadth the way they look at it, right? So they're saying that there's not enough bombed outness, even though it seems like there's bombed outness to me, the way that I'm looking at it quickly in our videos. So just something to keep in mind. And then while we're here, we may as well work this through quickly, because this is another point I want to mention. We're in, I believe it's as a quad witch, but I would think that the data is relatively similar, where this could be like quad or triple witch, either or. I'm not positive on that. I'd have to contact this person and ask them that. But what they're getting at is we're about to have 3 straight days down in the S&P into this triple witching, quad witching expiration. 1 week later, where are you, right? Especially when you kind of enter this oversold beyond just a few days, it's kind of oversold in other ways as well. Well, you have, since 1995, you have 11 occurrences. This would be the 12th, and the up outcome is 8 versus 3 for the down outcome. I'm sorry, looking at this 1 week column right here, and the average gain by the market in those 8 up are 2.7%, and the average down from here is only a little bit less than 0.5%. So that's even the max is not very much, right? So honestly, you get to see a 1% move back up. So I would say, look, you don't know what the Monday's news is going to bring. So you've got to be cognizant of that, of course. But Bottom line is, right, you're probably getting near an area where they try to step in without, if the news doesn't upend that. That would be my way of looking at this. I just wanted to bring that up. If I had the time, I would share a lot of things like this, but I can't. It just becomes unwieldy, and I just can't do it. So let's get into let's establish a few more things through the charts. So let's get this chart here, and then I'll try to bring this up a little bit on bigger picture stuff, but I'm still going to highlight everything. So we talked about the S&P, in this case, the spiders reaching that purple 200, stopped just prior to it on Wednesday, gap below it, brought it back up, couldn't close above it on Thursday at the purple line, and today with the where all hell is breaking loose to the downside, and you're hitting some of those fib levels that we talked about in terms of the retracement, 23.6%. We're into here, we're into the 200 on the IWM. We made it to there. This was a level we talked about a while back, that if they took out the 100, then we start looking to the 150. And it's really been a very tough trade, unless you just said, I think it's getting walloped. It's been a very tough trade because of the nature of this down move, right? There's been a lot of really curious uprisings, we'll put it that way. Anyway, you get down to you below the 200 in the Qs. You can see the purple line, a very similar scenario across the board in terms of like gapping below, trying to work back to it, struggling to get back above and hold, and then you just go further today. And let's see, your retracement is getting bigger and bigger on that one, so we'll have to talk about that. But I think you're at the 23.6 of the one we're concerned about. That's where I think we are on most of them. Diamonds, though, it looks like you're closer to the 38% retracement. So you're getting really close to that. Let's sort of amplify that by going into this chart right here. If I can bring this up, and I'll get rid of the VIX. And the VIX, we can talk about. I'm still long in the VIX somewhat. It's not acting well, and I don't, I'm not sure if there's been talk of suppression in different things by different notable people. I won't go into all those. Again, it'll just drag this out and on. I don't know exactly, but I took the opportunity to close out for some profits, and I think I got in a little bit, just naked long, small for now, and I'm just going to leave it like that for now, until we see what the over the weekend brings. Anyway, that has to do with these conditions we're seeing here, and the fact that this is an expiration and things like that as well. But let's look at the spiders. What I'm going to do is take the fib that we used last week and said, if they end up plunging, right, where and I'm sorry, if they end up holding, where would they start bouncing to? So I'm going to take this new low we made and say, what if this low holds? Okay, the downdraft has taken us to where? 644.72. So let's just say, what if that is the low? Right? What if that is the low and we start to bounce from here? Where do we start to get back to? And the first level, okay, that we have on fib wise is going to be just under that 200 day. It's going to be this 23.6 at 657. The next one's going to be the 38.2. That's where your declining 10-day starts coming in, that white line right there. There's also going to be this former, well, I shouldn't say former, but that resistance line. That's the line I was referring to earlier when I said we worked our way up to resistance. That was kind of in the title. They got to the resistance level there with that line and the 150 SMA there in rust. And then they rolled over, and it's just been selling. The news just hasn't helped. Obviously, the news continues to wear on. We talked about this a long time ago and many times over, but the market doesn't like uncertainty. We talked about Trump being a newsmaker, and sometimes it's not exactly predictable, and how we should be concerned about that and take that into account all those things and that all those sort of longer term, long distance warnings seem to really have helped in this situation. I think if you heeded them, you could see all the sort of Fruit Loops SMAs are rolling over in the SPY. And now, right, we went from, let's just round it off and say 698, and that's about a $53 drop. So that's about what, nine, just under 9%, eight and change, so that we've corrected now from the highs. So it's gotten serious. The last few days have just made it serious, where it was kind of minor until then, and now the last few days have made it serious. So these are the new levels on the way back up. As far as the bigger picture, let's look at the fib of where we backed off to, since we had to sort of go into this mode. And the fib we backed off to is the 38.2. No, I'm sorry, it's the 23.6 retracement. So I'm going to highlight that one and make it blue so everyone hopefully can see this. So that's the closest one that we've gotten to. What I want to add, though, is that I believe my Bollinger Bands are still set like I normally keep them. Let me just double check this before oh, I may have done a quick check to see how stretched something was at one point and forgot to shift it back over. So let me just do a 2 point right there to have up and down 2 standard deviations from the mean. This way the bands will look the way they should. And there's the 100-day, and there's your Bollinger Bands. Now, as I've said many times, I'm not so worried about a Bollinger Band excursion when the band's narrow, and that kind of the tedious year leading up to the last, say, few weeks, that really sort of constricted the bands and made them, made it for a boring affair for us and made the bands narrow naturally with the decrease in volatility. So now we did still get a pretty serious excursion below there, right? So we are still very far below there in visual terms, even though it's narrow. So I don't think it's the buy. In other words, I don't think this is the buy of a lifetime right here. But often after you get this, you normally try to get this little attempt to work your way back into the bands. And if you fail to retrace further beyond the fib, get back above the 200, or maybe there's even a declining set of SMAs that get in your way, or you could even have right where we fail to get through this resistance line that I'm going to extend a little bit right there. If it didn't let me, I grabbed the wrong line. And this is why I try to do things ahead of time, just because I don't like to have this wear on for everybody. But you got to do what you got to do. And so that would just making kind of drawing like an imperfect line. That would be somewhere around there. So if we were to work back up over here, you'd be looking at probably, thanks for switching to percent Thinkorswim just to prolong things on us. Oh boy. Sometimes it just doesn't go your way. But that would probably put us up to there. That's going to be around that 667-ish level, 665, 667, depending on how quickly, if in fact it does do that, how quickly it does it. Right. But overall, right, not really a good look. You can do the old inversion trick that a lot of people like to do because they're not used to being bears, so they'll put the minus sign in front of there, and you can see, and that looks like, right, this is good to do. I mean, if your eyes are more trained towards looking at the bull side, and you could say, yeah, does that look good? Yeah, it does. It might be a little stretch right now, but it looks good. And that, if it looks good, it really looks bad because you've inverted it, right? So not a bad little thing to do, though. A lot of people tend to do that and like that. Um, Anyway, that is the spider's look. You've pretty much got the levels there. You can see them. I know they're tough to make out. I know my charts are not always easy. I'm not sure what to do. I really don't know how I could tell you anything that I think might matter and something that could be a factor if I don't have some of the stuff on there. So that's that. Now let's take a look at the QQQ. And there are the fibs showing up there. And you can see that on the retracement of the whole move from all the way back from last, I guess it would be last, was it March that we're talking about? I need to go to a longer term chart just so we can be, was it April low or was it late March? I think it was April actually. So let's see here. Early April, maybe? Yep, early April. So that's going to be right. How much do we retrace it? It looks like that got, is that inverted? Why did that? Yeah, I don't know. Okay, yeah, so we're looking at the pullback there. We want to see the pullback, how far we're pulling back on that bigger fib. So, boy, this is tough. Let me try to hide this one. Um, you know what? I'm just gonna remove it. I'm just gonna remove that drawing. That way I'll add it back for us. But this way you can see it better that um, here we are with Qs, and you've made it to the 23.6 retracement of the whole move up since last April. You're below. It's the same story technically, right? And the next one down that's big will be 547 in the Qs. What would that be? That would be about what 33 6, so about 5 plus percent more. There's going to be naturally right in there, you're going to see some flat lines where the market respected those levels, like 561 seems like a good ballpark zone for one to give you an idea. But if you're looking just at purely at the fibs, it's there. If we talk about modifying this minor fib, which I'll try to do because we're looking at what if we do get a bounce. Which one's that? Oh man. All right. So 630, 660, that's good. And then today's low, I need to adjust a little bit. 578.54. And never know what's going to happen over the weekend, but I knew I'd be recording and I knew right that I don't want to sit here and try to execute while I'm recording. So um that's one other minor factor where I had to just bail on my heavier VIX call spreads. But I had a feeling, right, that because of all these levels that where you were at, and that people are pricing in some maybe rough stuff that it might be time for me just to be prudent at the moment and let them do their thing. If they do bounce, if it keeps going, not good for me, but if it bounces a little bit, I'll have my chance to reload at a different level. Anyway, that gives you the idea. The first one up would be 592 if we start bouncing on the drop. So from the drop to where we maybe have bottomed out, very premature to call it that, you're looking at about 592. That's right near your 200 SMA. So that would be right I mean, that would be a logical place, if you will, for this to try to work to. The round number of 600 is 38.2. A lot of your SMAs will be in that zone as well. So these numbers all this is why I do the what I call the composite stuff because a lot of times you'll see where different techniques end up, and these are just the classical things you can do. There's other things you can do, but you'll end up seeing where you can a lot of things will suggest similar levels, right? Where it's pretty close, and that's what I like to see. But I don't want to belabor the Bollingers here. You get the idea. The next level up really does. That 600 looks like, that kind of looks like gold if there is a bounce. That would be just under 4%, maybe three and change, I guess it would be from this level here, from the low, it would be just under 4%. Anyway, that gives you an idea on right what's next if we keep dropping. Fib wise, there's a really big chasm naturally, right? There's going to be other things on the way down, probably, like I say, flat lines, but other things you could do. But I'm keeping this straightforward. And then the next one, of course, would be the diamonds. The diamonds, similar situation. Looks like again a minor adjustment, but just to be clear, it looks like the diamonds almost made it to that dashed rust colored line. That's our 38.2 level and 450, which was 45,000, which was a sort of near the former high. I think we dropped that in there a little while ago, and that got really close to that, close enough for me. I am not a wait till the final penny person. I got cured of that after this happened to me. Imagine waiting for the 38.2 to perfection, and then imagine them bouncing it today and barely, it fell just shy. Then imagine them bouncing it back up to the 200 day. I'd rather have covered rather than having to live through them pushing things up 3% from where I was in my face. And that's what they do. So I try to always cheat in front of key levels, figuring that if it goes through, there might be a lot more, and that's okay, right? I'm still really close to where I thought it could get to. Uh, what's today's low? 453.54. So we have to adjust this fib from where I had it, and then that puts you, yeah, I mean, it's amazing, but the 200 and the 23.6 all suggest about 466. The next level up is going to dovetail with 23.6, a high, right, kind of like uh, a high right near where you topped out earlier this week, the 150 in rust colored and that one there. So you've got, that's it. I mean, it's 466 and 473. That's it. Now, could it go further? Sure. But I mean, I'm going to give you, even that would be a dramatic rise. Where we go below there, I mean, where does support show up? 446, let's call it. So that's down about 2% more. There looks like another level that was respected for a while, 440, and then finally, right, 436. That's your next 50% retracement on the fib. So there you go on that one. Then we'll finish up with the IWM. And I'm glad we were able to make the point of with the Bollinger Bands, because that's one thing I wanted to cover. We don't talk about those all the time. They're not relevant all the time, so we skip right over them. Has me baffled a little bit. I haven't had time to look into the composition and what is actually moving or not moving down, maybe moving up in here. But well, let's just do this first, since I'm not going to even cover all this stuff on the charts because it'll just take us too long. But this is the 10-year yield, and this just surged. I mean, it just ramped here. I mean, look at this, right? I mean, you are back towards, I don't want to go through all the trouble, but you're back towards where you were like last summer when things were really perking up. So you would think IWM is going to be interest rate sensitive and sensitive in other ways that some of these big dogs maybe are not. It's not really getting, not to say that it hasn't gotten hit down pretty hard. Of course it has, but it's not falling apart, as much as the diamonds, the blue chips. So interesting development considering how yields have just jammed. But whatever, that's why you really can't know exactly what's going to happen, even if you think it should make sense. And then in some ways it does, maybe you're missing, and in some ways it doesn't. But similar story, jam up, try to get to that resistance line we've had in there. It didn't get through. That was the end of it. Rolls over just like the rest of it. Here's your 200, and we're gonna redraw this one too. So the 200, it seems like we made it to there. That was the big sort of glaring potential target we talked about a while back. 240.33 is the low. Okay, and then that'll put us right there, right? So where does that give us? So the 223.6 is dovetail right near about 249. So I'm going to say, right, if you do start to see a real scamper back up, 249, our resistance line's coming right in there, roughly right around there. So in that ballpark, give or take $1, that's where you're looking at maybe for a first target on a jam job. And then 252 and change would be the next fib up. And that's where you're declining red 15. The 20 won't be too far. And of course, the 100, which is the dash line, won't be too far from there either. So again, a lot of that makes sense that you kind of come back to there if they're really are able to push things. Naturally, right, you're oversold. I mean, these things are either very close to oversold or are oversold. So you're close enough to say oversold. Of course, you can get oversold, but this is not nearly as smashed because it isn't below the 200-day, isn't below the lower Bollinger Band, whereas the other major index ETFs are. Does it have more downside potential? Of course, we don't know what the news will bring. 38.2 level is on the retracement from the lows of early April of 25, 233. So that would be another walloping, another 4% down. From there, right, you probably then go towards your 50% at 222. We'll round it off to, which would be obviously not quite 10, but close enough. Close enough, more like 9, but close enough to being super painful. But you can see it's the same thing. I really don't want to belabor that, where you can see all the short-term SMAs are rolling over, all the even some of your longer terms like 50 in gold and 100 in dash white leveling off, maybe starting to downtick. It's not, doesn't have that sort of downsloping look to it, but yet, hopefully it won't, but could, right? It wouldn't take much, wouldn't take much more. So that's pretty much that for covering the major ones and the levels that we can talk about. The other things I do want to talk about, though, that we haven't mentioned yet this week should be, is it, I always guess wrong. Wish me luck. Here we go. Yeah, there you go. I got it right for a change. So these we'll check these just in case it becomes real gloom and doom on, I'm assuming, news. Your 500 day is right near that 50% retracement in the IWM. That's your 500 day right there, sort of in that brownish color. So that's that one. Let's check. You can see that the 1000 day is way down there. Let's not jinx ourselves and start talking about that quite yet. The next one, and interestingly enough, in diamonds, the 500 day dovetails with the next fib. I didn't, by the way, like I didn't make my little dovetail point because I knew this was all the case. I'm just saying a lot of times it ends up being that way, not far away in the cues, as you may have already guessed, right? 519 there. It's really just 1% separated between the 50% fib and the 500 day, right? So these are all kind of bunching up in a classical way of saying, like, where could you really go to next in a big way? And it's there. And there's a little more separation there, I think, in the spiders. You got a 601 close versus 589. So that's a little less than 2%, but there's near your 50%. So if you think that this war or conflict type news is going to produce something, right, that's bad, then even worse, which it could. And we talked about the order of effects, right? And you could get this order, that order, and it could be spillover and turn into something worse. So if it does, unfortunately, right, these are some other levels that you might want to keep in mind. Let's just go and confirm, since we may as well, something we talk about every week, that really, breadth has gotten, it started to improve a little bit right away earlier in the week. And then, of course, with what's just happened here, you could see that all these breadth measures have had the stuffing kicked out of them practically, right? You've got cumulative volume has gotten smashed, McClellan oscillator right back down, and then your new lows are starting to really pick up now finally where they weren't before. So McClellan oscillator right back down. It's at levels, as we noted last week. It's at or near levels where, right, that have preceded rallies. So it's pretty beat up. It's not beat up to the greatest extent we've ever seen it get beat up, in any recent year. Let's put it that way. As far as the sectors go, again, I've seen people argue that this is being suppressed actively by the Treasury. We talked about that last week. Other things, at this point, the way this world's become, I had arguments with people over the years, and couldn't, they just couldn't fathom that there was manipulation in the U.S. equity markets, and I don't even know what to say. Like, I had respect for them. They were intelligent people. One guy was a professor at my university that was an econ professor and really very good guy. Just, I don't know, just accepting that, no, that doesn't happen. That's what you hear from people that are on the wrong side of the market. But, I don't believe that. I think I've seen enough from the governments over the years to believe that they'll do anything that they want. And when you don't have a really strong ethical or moral compass. That pretty much allows people to talk themselves into anything. But as we said last week, we said, you almost were full-blown risk off. I think it's safe to say, right, that you're pretty much full-blown risk off, maybe with the exception of XLK not really getting smashed. But they pretty much have come in, even things that were winning, like energy. Yes, did it go up this week? Yes, it did. Does it still look really good in the big picture? Yes. Could it use a breather in the short run? Yes. Probably should be trading higher. Yes, I agree with all that, but it's not happening, right? And so I feel like someone's leaning on it. Um, it is what it is. I can't really put my finger on it, but just want to highlight that we talked about this being ridiculous. I got out somewhere in here after being short up in here. Clearly, there was more to come with the market selling off. But just note, real estate, uh, healthcare, staples, even utilities, right? We said by the time they're done, if you do get a real sell-off, there's nowhere to really you can really hide, right? In the end, they just sort of start coming for everything indiscriminately. The one thing, I mean, you could say, well, what about XLF? It really doesn't look that bad. No, it doesn't if you look at the chart that way, but if you look at it in terms of, how's it, it's not a big mover. I mean, that's kind of a miserable right year so far after looking great, after really making a new high and then just reversing. So, the gang gone a gang, they do what they do. But so you could see between breadth and the sectors, it really is risk off fully. And you have to wonder, well, is that enough? Did it go enough risk off that it's too risk off? And let's pull up. Oh, I know what I want. Just get to our regular chart back, and I probably have to minimize this, and I'll show that uh, we have. If you look at, we could just look at gold, something we've been looking at, right? The gold and silver ETF, and they've annihilated these. And I think this is part of that, where it was trading at extreme premiums. Other places around the globe, they were having to shut the CME down to keep things under control. There's a lot of stuff going on like that. Luckily for me, I think I explained that I went very short term and reduced my risk. And this again, like sort of just being disciplined and so on and so forth has served me well over the years, and that's why I did it. When I felt like things had gotten really, stretched, they could do something. They did it. They did it right near this 423.6 fib that we had from way back, and now they're kind of really wrecking it. I'm not a bear at all. I'm not giving up on it, but that's what they did in there. We haven't touched on that. There has been some paper, but I really have put just a few in here and there on the bull side, never knowing if it could erupt. But you could just tell that the technicals just have taken a break, right? It's just taken a break at the very least. So I'd like to see it get back on its horse, and maybe it will. But I'd rather, as I often say, I'd rather trade with the momentum and with the trend, of course, and it's just not there, right? So I'm not going to force something on, even if I'm sort of have a long-term holder mindset in it, especially right for other folks. If the setup's there and technically and the paper's there, sure. But that's that on that note. We talked about things ramping up. The dollar yen is doing it again, so that's working its way back up. Don't know, right? That would almost be like if that starts breaking out, it did pull back after making a new high. If that starts breaking out, right, that could be problematic. So we just want to check on that. The other thing I want to check on is we'll check on Bitcoin, something we used to check on all the time, but it's fallen out of favor. Looked like it was trying to get it going. May still be on the verge of getting it going, but kind of a mixed technical bag right now with a longer term downtrend still in place. I mean, you're below most of your SMAs are downsloping, and you're below most of the longer term ones, right? You can see from the 200 on down to the 50. So I'm not really doing anything there in a big way. If they're going to wash that out lower and other crypto, I think I'm going to step in with a few things here and there. But right now, I've been minimized it. I told you, I think a few weeks back, I really have went from a great deal of positions to very few real active positions aside from a few things. I did get hurt a little bit in BTG is one that I got hurt in. That's one of my final things I was holding, unfortunately. But oh well, it's the number of things I got out of was I feel grateful, right? Even if I'm stuck with this one, my options are not doing well in there. I think I've got a decent size, not tiny, but not big, just decent size one, but that's clearly getting bombed out. Um, what else? Oh, SMH. This was the big one I wanted to talk about. So SMH, we've had this support line in there for a while, and it really, really fought to try to get back in there after plunging out of it. Plunged out, got back in, plunged out again last week, tried to get back in this week, couldn't, and then failed. Right. And so if this fails, that is going to be a really big problem. That's what XLK, the kind of like lone holdout, which is right below the 200. These are very correlated. So SMH, if that starts getting walloped, it's just going to be that's going to be one of the final legs of the technical stool that get knocked out on bulls if it is to happen. As it stands now, right, they have held above the lowest low and they're still above a rising 100 with the longer terms still rising. But I would ballpark, excuse me, as it stands now, I would ballpark, let's see, 28. That'll put me at 34.54. I'm going to ballpark that. I think you go to about, oh, thanks, Thinkorswim. I think you go to about 350. If you ask me for a ballpark number as to where we drop to, I'm going to put it at about 350, which should be all the way down here. So if there's another leg lower in this, I'm going to say it's going to come in right around 350. I don't even know why that number's showing up. Let me see if I can give us a little more time and just put a fib on there because it is a big deal of a, it is a big deal not only of a trader, but I wonder if there's a fib. I won't even draw this to perfection. I'm just going to see if something is in that vicinity at near 350 fib wise, that it seems like the level that it would go to. And I think, what was the highest high over here? This mess is too much. 430 and something? 437. 427. Okay. So 350, let's see if no, there's nothing there. Really is nothing there. So I'm not sure, but I've got it. That's where I'm ballparking. If we drop, I'm putting it at 350, regardless. So I like to see other things line up there, but nothing's really close enough to call it a confluence area or something like that. I don't even really see, well, you could say that maybe there's a little bit of support in the past there, but I don't see anything dramatic there. Still, that would be my off the top of the head target for that should that happen. Let me think about what else is there. So let's go. Let me just pull this over for reference, and I'll go through that. Theoretically, I'll go through this. So we are bombed out, but are we bombed out enough? Let's get our other discussion going. Okay. So yeah, it's all turning to butter crud, good old bad news bears line. It really is. It's just a very cruddy. It was one of the cruddiest weeks in UOA pro history. Just horrible paper. Not a lot of paper. Just not good. The CTAs keep, as we said, they were sellers in all scenarios. They keep leaning on the sell button. Um, there's still additional developments that could be serious. So there's and uncertainty. So I mentioned that earlier. People don't like when you bring that up, but I think the market just, as has been said many times before me, when I came on the scene, the market does not like uncertainty, and that's what we have, and we just keep getting more of it. There's no clarity. Um, we just try to weigh things out. As we said, right, there's a week plus to go, but the monthly charts are looking rough for the most part in the major index ETFs. The conflict dragging on. I think, hurt this week in terms of just a quick summary. The oil is not flowing. The military presence is growing. And these are all things that are not helping the market and weighing on the market. We talked about this. The straits clogged up. It's impacting economies. It's impacting commodities. They're talking about inflation coming out of it. It's disrupting, businesses and economies globally. The BB excursions we talked about, everything but the IWM. This I talked about early on, where we're getting to that point where, since it's another rough day, we're at the quad, which the bottom line is we probably historically have a better chance of bouncing rather significantly soon and within the next week or over the next week. Yeah, so this is the same as last week, where a lot of these things are not at bombed out worst we've ever seen, but they're certainly at levels that you could say, well, yeah, contrary to nature, and yeah, we should see some bounce or squeeze higher. We talked about the consensus, where we felt like a few months ago we were worried because we were on board with almost every other Tom, Dick, and Harry out there. And again, I would just say, tuck that away in your mind, that when you find yourself there, be careful, because that is a dangerous place, and we've just seen that yet again. I hope that someone remembers that out there, because that's why I take the time to bring, when these thoughts pop in, I could just skip right past them, make the videos shorter, but things like that help me when I learn them, so I try to convey those. Um, and these are problems too. So we're talking about, yeah, it's bombed out, but this is just like the BOA said. I had this in there for a while, but lack of capitulatory selling is problematic at this point. I don't know. Did we see it today? I don't know. I don't know how heavy this day was on volume. Um, but the prices being paid for hedges are supposedly extreme. It's not showing up in the VIX. And then retail still buying like champs, as last reported, or I came across. So not good, right? You really want to see retail throw in the towel, just like everybody else, and then we'll get that capitulation. It'll be over. We can get a good bounce. We have upsloping 200 SMAs, but we are now in deliberation as to whether or not they're still support, or are they going to turn into resistance, and that would be horrible. So the subsurface ugliness in this market is nearing Colos degrees. There's your visual reference to the right for that. I'm going to leave it at that. Someone, without Googling it or whatnot, should know that what that references. We talked about that awfulness. We talked about preceding it, but of course, making a call here is fool's folly. You just don't know what news will be coming out. We talked about fully risk off. I remembered some of these things. Yep. So it's very poor. How much worse does it get normally? And then the housing market is disaster unfolding in a slow motion right now. And again, that's 70% of the economy. That just seems really problematic. So the way that a lot of people are looking at it, if we get this war thing out of our system, this conflict thing, we're just going to go up, up, and away. I hope so. And I don't like to sound like a jerk, but I'm not so sure I'd get that far ahead of myself, because I think, right, it's one of those things like you see in a movie where someone thinks they beat the bad guy or one of his key henchmen, and then another 10 henchmen show up to fight the guy and they fight the hero. And that could be the case here. So I wouldn't do any celebratory dances. I don't think that'll stop people from doing them, but I personally wouldn't be doing any celebratory dances if we pop back up 3, 4, 5%. This is still big psychologically right now in my mind. I still feel that these risks are underappreciated to this degree, to a lesser degree than it has been, but to some degree still. Not saying fully, but just to some degree, I still feel like the risks are underappreciated. Let's see. The econ numbers we talked about last week, it's looking rough. The reverse yen carry trade we talked about. There's all these things are still there. We talked about TNX. Dealers absorbed a lot of inventory. Still true. But again, we said, will the CTA selling constantly just outweigh that? That do they have to absorb more? Seasonality too should be helping soon. Should have maybe helped this week, but clearly, right, with this Iran, blah 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 blah, all the rest of it, and CTA selling, and the technicals where they are, there's no let up. These things are all elevated. Some of these things appear to be suppressed or subdued, according to some. I got to get to there. We talked about nowhere to hide. We talked about more problems pulling, bubbling to the surface. All these things I'm leaving in there. These are just reminders. Let me briefly try to pull that in. Bear with me. Let me see if I can do this. And then I want to bring in I'm going to do the Mag 7 first. Let's do the Mag 7 while we're here. We talked about this, so then I'll just be able to end on the one graphic. We talked about this sort of staring into the abyss, and we were concerned that this could really weigh things down. And a lot of these stocks, I think they had a rough week. Overall. Let's see. Netflix isn't really still part of it. I don't know, but we'll include it. And then Tesla. Okay. And here's your Mag 7. And we talked about how it needed to hold last week, right near these lows that it was at, right around in here. And let's say on this chart, that would be 24.55. And you can see that that gave way. And this really, of course, is the reason why we charted, knowing how big those weights are. No, that really hurt the market. It's very hard, I think, for the market, the major index ETFs to do well with these stocks as a group performing like that. So again, probably worth watching, keeping an eye on it. And it's now, you can see the Bollingers are fairly wide on the Mag 7 right now, or Mag, whatever we just charted. I don't even know how many stocks we popped in there. But you can see this is definitely oversold, right? In other words, like that's definitely oversold right now. So you might not say it at the bottom today. We were definitely oversold. So can it go further? Of course. Greg McDermott, our friend and former colleague, he made that point all the time. Oversold can become oversolder, but at the same time, it might not. It might not, but it can, that's why this is tricky. Anyway, this is not I asked Ryan to send this to me because this is not, hey, Ryan's great or I'm a genius, but I just wanted to show everyone that I talk about this a lot in this video when it starts getting dicey. And I don't know how many people ever really understand it or pay full attention to what we're talking about, but Ryan has been putting on these types of as we say, but when these were downside butterflies, Ryan was putting these on. And for traders in the Phoenix portfolio that I mentioned, other things. And I just wanted to let you see that where they took things off at, right? Though the return on this particular butterfly was 1100%. So, that can go a long way towards helping your portfolio weather the storm. Or, again, if you wanted to go like me and just kind of like turtle up and not really have a lot on and just have mainly long VIX stuff, things like that, you could have, and you could have done that. But this is another way to go if you want to play offense too, right? Where it can be low risk, but you can get some really great returns. Unfortunately, if the market does start to really get shillelied like it did, so with the Qs kind of like going down to his target at 585, the mid strike, right, is the one that Ryan was, that's the one he was short. The other ones were really, where he was long the other puts against that on this is of course done on ratios when you do a put butterfly. So it's 1/2 -2/1, starting at the highest strike. So anyway, the point is that it's a massive return. It could really help buoy it. We do these for real. There was a portfolio protection course. There is a portfolio protection course. I'm not saying that this whatever 7, 8, 9, 10% drop, depending on what you're looking at in the major index ETFs, is this great bear opportunity, but it is a good opportunity overall, right? It's not like this has been a complete crash. But yeah, when you get to the short strike anyway, that's when you really, if you're worried that it's going to keep going, that's when you've got to take it off. If you think there's more downside or a strong bounce potential, you're going to want to take it off when it gets to your short strike. So I think there was a little bit of time left on this one, but he just took it off anyway and said, I'm just going to wrap that up because I don't know how much better you expect to do. But yeah, you can really do super well with these, which is why I mention this type of thing all the time. I just wanted to show that one that, the proof's in the pudding right there. And you can talk to Ryan about that in any of the webinars. And if you can't cover it in that one, maybe you could come into another one or whatever the case may be. So on that note, I'm going to wrap it up and just say, you've got to be nimble. We don't know what the news is going to bring. You're at a spot, in summary, you're at a spot where you could easily justify a rally attempt, just as you could say, well, if the news continues to not trend the way the market wants, you could easily drop another whatever percent. No question about it. So you're stopping at a level you'd expect to stop at. It might this triple quad slash quad, which I'm not positive. I think it's quad, but that could also be the complete unwind, and you could get some relief from that too. So you might get something like that. We'll see. Let's hope that we do. And then we will, we'll go from there. But again, I think the smart players that saw some of these clouds building and said, let's just rein things in a little bit. I think even if you're not doing that great, you're just trading scratch, right? You haven't made that much money lately. You've got to remember that a lot of people are getting crushed, and so you sidestep that, and now you have dry powder in the form of dry cash, cold cash that you can deploy at lower levels if you care to, if you're still a big long-term bull. So that's the advantage, I think, of doing this and being willing to let the market, if the market were to make a new high and start breaking out and you sat it out, then you'd have to maybe get back in. But if you're willing to just be patient and see when a lot of things are brewing that hey, wait a minute, what if it doesn't do that? Is this a great place for me to stop? Especially when, every Tom, Dick, and Harry was bullish, including us at one point earlier this year, because things look great on the charts. That's when you have to always have a heads up, your head up on a swivel and say, well, how many people were talking about this Iran conflict as part of their calculus, with their grandiose predictions, at the start of the year? Probably not too many. And I'm not taking a shot at anyone, by the way. I'm just saying a lot of people look past all these things that can develop. And that's why I'm not a big fan of, table pounding on things. If I'm forced to come up with a forecast and predictions, of course I try to do that, but I'd rather play it smart as it develops to the best of our abilities. That's just a different philosophy. So not a popular one either. Anyway, on that note, thanks for tuning in. I do hope that something I share with you helps you out this upcoming week or some week in the future. And yeah, and we'll go from there. So everyone take care. Thanks for tuning in.